Yes, welcome once again. And subject matter of tonight's class is business valuations. Business valuation. I don't know if anyone have taken his or her time to, to try to understand what these words are. Business valuation. Business valuation. Why do we need to value business? And why must this come? So please, as I explain, kindly take down certain points. Yes. So business valuation, this involves the process of determining the worth of a business, the worth of a business, or is a process of determining the worth of a company's share. Now, when you want to determine the net worth of a business as an accountant, what are the variables you have to look out for in your statement of financial position? As far as you're in this class, you're an accountant, and very soon ACA will be attached. So, and I know I have auditors in this class. When you go to audit your clients' books of accounts, how do you determine their net worth? Can I get a response to that? Because these are what this topic is all about. You can be given sample or extract of a financial statement, and you'll be required to determine the net worth of that business. So how do you determine net worth of a business? Just give me simple ratio, simple equation on how you determine the net worth. What are those things you look out for? Yes, very fast. All right, I'll move on.
I will
The
look at
assets.
asset and the equity.
Asset and what?
Equity.
Okay, asset and equity. Asset and equity. Okay, yeah. Now you're talking about assets. Okay, all right. So in simple terms, for you to determine the net worth of a business is your total assets less your total liability. So a business valuation might include an analysis of a company's management, its capital structure, its future earnings potential, or the market value of its assets. You know, there are various ways you can value assets of a business. Yes, various ways you can value asset of a business. So valuation can be carried out in several ways, depending on the nature and purpose of the transaction involved. Now, why business valuation? Why are you trying to value this business? Will lead you to the variables you are to look out for. So there are quite a number of reasons why we value business, and business valuation can be carried out for quite a number of reasons. And one of it is when we try to look at issue of estate and tax purposes. So business valuation is required not only to file an estate tax return, but also to provide guidance to the personal representative to fulfill the terms of the descendant's will. Now, when we talk about estates, talking about properties, wills, testament, and the rest of it. So most times people think when you value a business, it's just for tax purpose. No, it's beyond that. It's for you to know the worth of what you have. So valuation of an estate will be necessary in most instance to minimize ultimate tax liabilities due to the relevant tax authority. Because if you don't know what you have, you can be charged unduly, unnecessarily. There can be excess burden of tax on you. So you need to know the worth of what you have and the actual value of tax that should be levied on you. So one of the reasons for valuation is for estate and tax purposes, and another reason is for mergers and acquisition. Mergers and acquisition. So business valuation may be required when a company acquires another, yes, and or where a company merge with another. So in terms of merger transaction, the individual company, yes, company A and B, we need to evaluate what they have. So the individual company may need valuation in order to ascertain their current worth. Yes, in terms of merger now, individual companies will need to evaluate their current worth. While in an acquisition, only one party to the transaction may be required to carry out the acquisition. So the issue of business valuation will always come up when you want to merge with another. You need to evaluate what you have in terms of assets, in terms of assets based on current, based on non-current, and the rest of it. So you know what you expect from the other party, the other business that is trying to acquire you, and to see how you can share the returns in terms of major, in terms of major. So another point why we value business, why business valuation will likely set in, is when we look at issues of shareholder and partnership disputes. Shareholder and partnership disputes, because ownership dispute results from many different circumstances, and most commonly it's often results in disagreement between owners, disagreement with a merger or dissolution, or other related issues. So business valuation is necessary to reduce certain disputes that may arise when we have issues of partnership disputes and the rest. So another point where business valuation can come in has to do with when we have issues of marital dissolution, divorce. Yes, because two parties who have come together as husband and wife can engage in a business, and due to unforeseen circumstance, certain issues can occur that will warrant separation. So in some countries, when a private owner gets divorced or a private business owner gets divorced, evaluation may be required to divide the marital estate. So whether by agreement of the parties or by a judge through a trial. So this can also result into valuation of properties, but often both sides obtain separate valuations. But there is also a movement towards collaborative divorces in which the parties agree to hire a single valuation expert. Yes, because by the time I'm coming with my own valuer, you are coming with your own valuer. You always want to take value the properties in a higher way. And Mr. B will also want to value it in a higher way. It's better we get a neutral valuer to ensure that everybody is in consensus and things move on smoothly. Another point where we have issues of valuation is in the case of loan facility or bank lending. Yes. And we can have issue of valuation in terms of when liquidation wants to set in. So when a company wants to liquidate, the assets are realized. There's what we call net realizable value. That means at that point you want to pack off as a business. So when you sell that asset, what will be the return? So appropriate valuation of a company asset by experts will always ensure that fair value of the asset is determined before being sold. Yes, for those of you that have passed FR and that are still writing FR, some of these things will always set in, always set in. So business valuation is one of the major and important duty of you as a financial manager. So as far as we're in this class, you are my financial manager. You are to advise me come November exams on certain things I need to do, as the examiner will put forth the question to you. So business valuation is one of those areas of finance which attracts deep interest from the general public, as well as finance specialists and managers. So it's very important that we expand the activities of organizations by evaluating their assets and evaluating their liabilities. So the point is the circumstance. I'm trying to reflect back on what is in the study pack now. The circumstance of valuation in the study pack, they put it in two ways: that we have issues of quoted companies and unquoted companies.
In fact, I'm unable to hear you, sir. Is it my network?
Same here.
It's general. It's general.
Thank you.
No, 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 no.
Madam Noble, don't worry, I'm back. So, given that share prices are always available on the stock exchange, and to most investors, they can easily value the worth of a business by how well the share of a company is doing in the stock exchange market. So the question is, why do we need to devise another techniques for estimating the value of a share? So a share valuation is necessary for quoted companies when there is a case of takeover bid, or whereby the offer price or fair value is in essence of the current market price. So there will always be a need for valuation. For quoted companies, these are companies which shares are available on the stock exchange market. Now, for unquoted companies, why do we need to value them? We need to value unquoted companies in instances whereby there is a need for their shares to be given out. And also, the shares of unquoted companies can be valued whereby there is need for pledge, where a pledge is to be made using the shares of unquoted company as a form of collateral for loan, and also where there is a scheme of merger or takeover, just as I've mentioned. So the key point is sorry, I'm not moving my slide because some of the things are not actually there. So the method of valuation, the method of valuation, we have the asset-based approach, we have the income-based approach, and we have the cash flow-based approach, but the syllabus is not asking us to do that. If you've watched the video I forwarded earlier, you see a question I saw leading to cash flow, free cash flow. Yes, but this FM syllabus is not asking us to do that. So the asset-based approach, what does it entail? Asset-based approach of valuation of business. The asset-based approach. The asset-based approach. This method of valuation is usually used as a guide in determining the minimum value of a company's net assets. So in the event of merger and acquisition, net asset basis cannot be used as a single method of valuation because it may produce the most, because in this case, it may not produce the best realistic value. Yes, the asset-based approach. So there will be the need to look at various methods that can give us the best approach. So also under this asset-based approach, we can use the net asset approach, and the value of the business or share will be calculated as what? Give you what? The net assets. To give the net assets. And when you do that, you can divide the net asset by the number of ordinary shares in issue. So the asset-based approach to valuation can be based on one, book value. Please take note of that. Book value. Book value. Book value. And what is book value of an asset? Can somebody speak to that? Book value of an asset.
The book value of an asset is the carrying value of the asset as at a period of time.
Okay. Can you come again, ma?
Okay, I said that the book value of an asset is the current value, like the value as at the maybe AFS at the reporting year. So the current balance of the asset by the point you are reporting is the book value.
Any contrary opinion to that? So everybody is in agreement with that.
I will put it this way. It's
Yeah, there's value in the statement of financial position.
The value in the statement of financial position. Is it
Book value.
so when we're talking about the book value, please take notes. When you go to I'll refer you to the study pack. You will see an example there. I don't have it on this system here. There are very simple examples there. Now, you'll be tested that using the book value, evaluate this business. The book value, this is also known as what? Historical value. Is also known as what? Historical value. It is calculated as the difference between total tangible assets and total liabilities. So the intangible assets, such as copyrights, goodwill, and so on, are ignored except when they have a market value. Because most times, how do you quantify goodwill? Do they have, most times you cannot actually get a market value for it. How do you quantify copyright? They are intangible. The goodwill I have will vary from the goodwill Mr. B is having. So there will be no standard market value for it. So take notes. So when you are solving and you see issues of intangibles, you ignore them. So I said book value is also known as the historical value. That is the actual value an asset is purchased. And over time, there will be depreciation, there will be depletion, amortization in the case of intangible assets. So, and that difference will give you the net book value. But when you're looking at book value, your attention should be on what? The historical value, the cost of the asset, as at the point it was purchased. So under asset-based approach, we have book value. Also, we have replacement value. Replacement value. Let me say I can transfer this study pack to this. Replacement value. Replacement value. So when we talk about replacement value, these represent the costs of setting up a similar company or the cost of trying to replace an asset. It is the maximum amount that the acquiring company will pay to a target company in the event of merger and acquisition. So when you want to acquire an asset, how much will you pay that organization? So under this method, known as replacement value method, the value of a business is determined same as under book value. Take note of that. It's determined same as we do under book value, but the historical value of some of the tangible assets are replaced with the replacement value. Please, sorry, let me just give me a few minutes. Let me transfer the study pack to this system so we can see practical examples, scenarios of what I'm talking about. Or if you are with a laptop and you have the study pack, you can share your screen. So that we'll get what we are trying to say in a clear manner. Few minutes. So, still talking about this replacement value. So this method of valuing a business, do you think it will be much more practical in an organization that deals with intangible? Okay, fine. I'm just trying to, you can share your screen. Trying to get the study pack. Okay, yes, fine. I have it now. Yes, Very fine. Yes. You can go to the replacement value. Yes. You can show us the example, sir. The example. Fine. Yes. Fine. Yes. You can see this question. That's calculate the value that the financial position of calculate the value of Ozone PLC using net assets historic method. Now they are not telling you book method, but once you've studied very hard and you've listened to this explanation, you should know what historic method is, because in my explanation I said book value is also known as what? The historical value. So when you go to the example and you see it, don't begin to wander around. What is historic method again? Yes, it's another word for the book value. The book value. So, just a few minutes. Let me get it to my system too. All right. So, looking at this example in relation to net asset value, why I'm bringing this up is because I know some people have not bothered to check the part, find out the study pack. So, I want you to start using the study pack. Yes, even as you study. So, as I'm referring you to this. So, the directors of Dangote PLC, a large conglomerate, are considering the acquisition of the entire share capital of Ozone Limited, a private limited company which manufactures a range of engineering machinery. Neither company has any
Can
long-term.
you explain it? I can't see your screen. It's still that common valuation method that is showing here.
Maybe
I'm
it's
not
the network.
displaying, somebody else is displaying, and I'm seeing the person's screen. I don't know if I'm the only one seeing the person's screen.
I can see it, Joe.
I can see it. You can log out and log in.
See it.
Why is this voice sounding like Chidima's voice? So the neither company has any long-term debt capital. So in this case now, what can you tell me about this company? Are they geared or ungeared?
On Jed.
So what can you tell me about this company? Are they geared or ungeared? Or you are confused about the word geared and ungeared? Levered, unlevered? If you don't know at this point, that is not good. So the directors of Dangote PLC believe that if Ozone is taken over, the business risks of Dangote will not be affected. So the statement of financial position of Ozone as at 31st December 20X5 is expected to be as follows. So you can see, can you scroll down, sir? Or is it? All right. Total assets, you can see non-current assets, net of depreciation, current assets, stock and work in progress, receivables, bank. Then we have equity and liabilities, issued ordinary shares at ₦1 each. We have 100,000 for that. Distributable reserves, 808,200. Shareholders fund, overall 908,200. And payables 1,507,200. Bank overdraft 1,725,800. The estimated values of ozone non-current asset and work in progress as on 31st 12/25 are, you can see, replacement cost, realizable value, non-current assets, stock and work in progress. Now, required, calculate the value of ozone PLC using what? Net asset historic method, net asset realizable value method, net asset replacement value. Can you move to the solution, sir? So the solution now, let's see what the study pack is telling us. That net asset valuation historic method, it does not include what? Intangible what? Assets. Did I mention that in my explanation?
Yes.
Yes, sir.
Yes, sir.
Yes, it does not include intangible what? Assets. And so is equivalent to shareholders' fund. No adjustment should be done on the statement of financial position when using the historic method. The net asset valuation is 908,200. Can you go back to the question, sir? Let's see, sir. The net asset valuation 908. Okay, move up a little. Yes, fine. So, looking at this question, the historic approach, using the historic approach, the book value approach, the value of this business, is 908,200, because all these issues of replacement costs does not affect the issues of non-current assets in terms of net realizable value and in terms of replacement value. So the value of this organization, this company, is the fund, the shareholders' fund, the summation of the ordinary shares and the reserves. Now, one thing as we go ahead, as we look at issues of business valuation, as we move to things like earning per share, you don't consider issues of preference shares holding, because the preference shareholders are not the real owners of the business. What you consider is just the ordinary share value and the retained earnings. Yes, the retained earnings, because it is when you less the amounts going to the preference shareholders, the residual value available is what you distribute to the ordinary shareholders. And based on your company's policy of retention, how much you retain from your leftover, you have your retained earnings. So based on this now, the historic approach, the worth of the business is the value of what? Of the shareholders fund. Value of the shareholders fund without any adjustment to the statement of financial position. Without any adjustment to the statement of financial position. Now we can have a case. Can you move downwards, sir? Can you move back to the question again? To the requirement. To the requirement. Okay. I think I have the question. Okay, fine. Now calculate the value of ozone PLC using net assets realizable value method. Net asset realizable value method. Now, let me talk about that. I only talked about replacement. When we talk about the realizable value, this is the amount the selling company will realize if the assets are sold on a piecemeal. Yes, the assets are sold on a piecemeal basis. What do I mean by piecemeal? In fragments. And this net realizable value is the minimum amount that the target company will be willing and ready to accept from the purchaser. Yes. How much are you willing to accept for giving out your assets, your properties? So the value of a business is determined same as book value basis, but the book value of some of the tangible assets are replaced with the realizable value. So when you look at this question now, sorry, can you go back to the question? Can you move upward a little? Yes. So if you look at the question, you see they gave us two options: replacement cost, realizable value. This realizable value is telling you that the value of this non-current asset as at today will be what? 900. The value of what? Of stock and work in progress as at today will be what? Will be 1,140,000. Now, when you are to look at replacement cost, it means that if you want to replace your non-current asset as at today, it will no longer be what? 1,303,200. It will now be what? 1,450,000. If you want to replace your stock of work in progress, it will no longer be what? It will no longer be 1,031,800, but rather 1,100,000. So what you do is to replace the values, these values in this statement of financial position with this amount here to determine the value of the business. So you can take your time to look at this question again, even as you study. Yes, you can see from the solution, the net asset value in terms of replacement, the least old value, less old value of stock, less old value of non-current asset. Then you add value of new value of non-current asset, add new value of stock and work in progress, and you get your answer. So there is no any big deal about this. Yes, there's not any big deal about this. So the asset-based approach have three methods: book value, replacement value, realizable value. Some authors can go further to include liquidation stroke break up value. Yes, some authors, just for knowledge, is just addition, is not in your book. Yes, they can go ahead to talk about liquidation and break up value. Because I know so many people can go and read and say, but you didn't. I'm being guided by what is in the syllabus. Yes, that is it. So we can also have another way of valuing a business, the income-based approach. Income-based approach. Income-based approach. Yes, the income-based approach. When we talk about this income-based approach, we have three issues under this. We have issues of price earning ratio. We have issues of dividend yield, and also we have issues of earning yield. Now, when we talk about this price earning ratio, this represents the ratio of share price to earning per share. You know, when we are solving ratios and when we come to these points in ratios, sometimes students get bored. That's this issue of earning per share, dividend per share, anything else. I'm trying to determine dividend yield. So you just have to fall in love with it. So price earning ratio said this represents the ratio of share price to earning per share. So price earning ratio is often used to value companies with an established profitable history. Yes, because this method is used to achieve valuations for quoted companies. Companies that are not quoted, unquoted companies, we have to to leverage on the data of quoted companies for them to achieve proper valuation in terms of price earning ratio. Because for you to be able to to determine price earning ratio, the company must be quoted. So where a company is not quoted, that is quoted, and try to borrow a leaf from them and see how you can evaluate your business where you are not quoted. So listed company shares are much easier to buy and sell and are perceived as being less risky than unlisted companies, because listed companies, they have track record. You can have great confidence in them as it regards their performance. But where a company is not listed, you begin to think, is this real? Is this company real? But where it is listed, you know they've passed through certain litmus tests and that warrant them to be listed on the stock exchange. But where you are not listed, you begin to have some double mind. So because the companies are listed, they are more attractive to investors than shares of companies that are unlisted. So unlisted companies do not have price earning ratio, which make valuation almost impossible for them. Yes, that is for unlisted companies, unquoted companies, as some authors might put it. So, as a consequence of this, when valuing an unlisted company, it is necessary to adjust the price earning ratio of a comparable listed company downwardly. That is between a proportion of 10% to 50%. Yes, I think this values is also stated in the study pack. Yes, you adjust downward in the proportion of 10 to 50%. So depending on the passive risk associated with the unlisted company. Well, the point is this: the higher the risk associated with an unlisted company, the greater the percentage. So using price earning ratio, the value of a business or share is calculated as what? Price earning ratio multiplied by what? Earnings. Price earning ratio multiplied by earnings. Though in the Pathfinder study pack, it is put as what? Earning per share multiplied by estimated price earning ratio, which is same as what I've said. Yes. So that is price earning ratio. Price earning ratio. In my slide, I have some examples. Yes, I think I have some examples regarding that, but let me just do the talking first. Then we look at some piecemeal examples. Then I have much broader examples also. For those that always like to ask for questions, I will just send my slide to you. You go and solve the questions, and you get better. So we also have dividend yield as a way of income-based approach to business valuation. Dividend yield, dividend yield, dividend yield. So this method values a business as the ratio of dividend to dividend yield. me see if I have that here. All right. So dividend yield. Dividend yield. This method values a business as the ratio of dividend to dividend yield. So it represents the present value. Take note now. The present value of all future dividend payments discounted at the rate of return to equity holders. So what this does is that using dividend yield as a basis, the valuation can be calculated as what? As dividend, divided by what? Cost of equity. But when you're looking at dividend yield, there is something that must come to mind. We can have a case of growth. That is where the concept of Gordon's comes in again. Yes, growth. So the formula to calculate dividend yield is dividend, that is current dividend, divided by cost of equity. But growth will also always set in terms of dividend. And where growth set in, the formula will be what? Will be dividend multiplied by what? Into the bracket 1 plus growth rate divided by what? Your cost of equity minus growth rate. Yes, cost of equity minus growth rate. Some books will put it as earning yields minus growth rate. Earning yields minus growth rate. That is some authors. So it can be put in this way. Let me rewrite this formula you're seeing on the screen. It can be put in this way. It can be put in this way as market value equal to DO into the bracket of what? 1 plus growth rate divided by what? R minus growth rate. You can have it in this way. So as I've said, you always see different formulas. Please just stick to the 1-to-1. Don't get confused when you go and open different books as a result of your curiosity to learn. You can just get yourself confused and the whole thing will become so boring and so devastating. So once you are reading, know the best book or material that suits your understanding and stick to it. Don't jump from one book to another because your friend is using this. You're also running to that. Know what gives you understanding and stick to it and become better and better and pass this course and go. So whichever formula you use, once it suits the question, you are fine. So if you go to 10 textbook, I'm telling you, you see different ways of writing these formulas. Yes. But the point is, once you apply them appropriately, you get your results. Same results. So in this formula, we can define each of the variables as what? This DO will be what? Your current dividend. And what? The G is what? Will be what? Your growth rate. The G will be your growth rate. And what? The R will be what? Your cost of equity. R will be your cost of equity. The R will be your cost of equity. So also, we can have issues of earning yield. Earning yield. Earning yield. When we talk about earning yield, who can tell us something about that? Earning yield. Earning yield. Yes. Earning yield. Oga Priest, are you there? Earning yield. Let me see those on this call. Earning yield. Madam Faith, Idowu. Earning yield.
Good evening, sir.
Good evening, Mal. Some of you have read this topic. Earning yield.
Okay. I
And
just
some of you are
joined.
doing
Actually, I'm trying
Yes.
to find my way around what you are saying, but normally earnings is the revenue or the income the organization make. So the earnings yield is what will what okay what we produce or what we make them have more revenue, something like that. Yes.
Okay,
Um,
okay, let me come in. Earning yield. Is it not the profit on what you make from the stock or from your investment? Yield, the outcome, earning, what you got from your investment. I'm just trying to
right.
make it layman understanding.
Thank you for emphasizing and stressing the word earning yield. So earning yield, this represents the present value of expected future earnings of a company, discounted at the expected rate of return to equity holders. So based on your, yes, layman understanding that you've said, fine, the earnings that will result as a result of today's earnings, future earnings that will result as a result of today's earnings, because today's earnings all will not be consumed. There will be retention, there will be retained profit. That retained profit will be used in the expansion of the business and it will yield future returns. So earning yields represent the present value of the expected future earnings of the company, discounted at the expected rate of return to equity holders. Who are the equity holders? The ordinary shareholders. So it is the ratio of the expected earnings to return of investment. So valuation using any yield basis can be calculated as earnings divided by rate of return. Earnings divided by rate of return. Some school of thought, we say it is earnings divided by market value. Market value. So also in like manner, where the earnings are expected to grow at a constant rate to infinity, to perpetuity, the formula will be what? Will be earnings into the bracket of 1 plus G in this respect now. 1 plus G divided by what? R minus G. What is your E? Your E is your earnings, that is expected future earnings. Your G will always be your growth rate, and your R will always be your rate of return. Yes, as it regards to this. Let me go back again and pick some examples aside what we have in the study pack. Yes, the study pack examples to me are much more easier, though there are some examples in my slide that I will not talk about today. Yes, I have quite a number of examples in this slide. Yes, there is You can see a combination of WACC and inflation reflecting. So everything you've learned in the past will always resurface in one way or the other. Allowable depreciation, capital investment, corporate debt. And see another one. Okay. All right. But let me go back and start with some more simpler example. We'll just treat like 2 or 3. Then we look at this aspect, efficient market hypothesis. If you go to the SFM study and Pathfinder, you see a question on it. The examiner is trying to tell you to explain when a market is weak, when a market is semi-strong and strong. It's all about information in the market. So let's look at simple examples for now to enhance our understanding, because when you teach and you go and start from the complex one, you start making these students who become scared of what you're trying to pass across. Even though I know some people like that one, that complex one. Or me, I don't like to confuse the students. Some people will always want you to go and start with the complex. So you have to bear with us if you are ahead of what we're talking about. So let's look at this question. Let's take this question. Let's say faith. Faith now. You must have faith. Faith intends to acquire Idowu. At least this is one person's name in this class, so it's not. I'm not using somebody's else to acquire another person. It's acquiring herself. So Faith intends to acquire Idowu Limited. So the acquisition, let's say the acquisition now. The acquisition will lead to an increase. Will lead to an increase of, let's say, 25,000 per annum. Will lead to an increase of 25,000 naira per annum for 10 years. For 10 years. Now, let's assume 20% cost of capital as far as financial management is concerned and SFM. This cost of capital, you can't run away from it. As a matter of fact, I was telling someone, expect this in your number 1 question as far as this exam is concerned. So if you don't know cost of capital, that thing we treated last week and about 2 classes, go and know it. If you are struggling with it, ask your question on the platform. Somebody will respond to you. Because some people will send me message, I'm busy, I would not like to look at it, because once I look at the message, I'll get distracted with what I'm doing. So that is why sometimes you send me message, it will take me a long time. I will be online, I will always be online. But sometimes I will not just check those messages, because I can be busy with something that needs my attention 100%. And once I look at that message, out of my own magnanimity, I want to quickly attend to you. And in attending to you, something else is suffering. So that is why I decide not to be looking at messages promptly again. So assume 20% of cost of capital. What is the maximum price to pay to acquire Idowu? So looking at this question, can anybody give us a guide? A guide on what to do? Any guide? Any guide? This is simple. Faith. Any guide? That Faith intends to acquire Idowu Limited. The acquisition will lead to an increase of 25,000 naira per annum for 10 years. Assume 20% cost of capital. What is the maximum price to pay to acquire Idowu? Yes. Any attempts? Kim Godfrey, Iene, Bironke, Mr. Timothy, Madam Tai, Madam Victoria. Oh, you people are eating. You know, I'm not seeing you people. You can be eating.
Seriously, like, sir, I'm just entering the class. So my from kitchen to the table, and so my attention is a bit divided too.
You see, my judgment is right.
Yes.
And some people, they are busy carrying their baby. Don't worry, you will all pass. It's fine.
Amen. No.
I understand it's not actually easy, yes. But as a tutor, I always push. My own work is to push you. So don't mind me. So solution, please. The point is this. Let's say since the acquisition, since the acquisition will lead to what? Will lead to an increase. Since the acquisition will lead to an increase of 25,000 naira. Not just 25,000 naira now, but per annum. For how many years? For 10 years. For 10 years. The value of what? The value of Idowu. Yes. The value of Idowu will be what? Will simply be the present value of the amount in 10 years. I don't know if somebody is getting this now. Of the amount
No?
for 10 years.
No.
Of the amount for 10 years. And what? And since it will be constant, and since it is a constant amount for the specified period, what will now be our value? Our value will be determined using what? Which value are we going to use to determine our present value? What will be the approach? Somebody should tell me.
Maybe we are going to use annuity formula.
Annuity. Because it's constant. We're going to be using annuity factor. We'll be determined using annuity factor. Another word for it will be what? Cumulative discount factor. In case you see that in exam, don't begin to ask yourself, what is this cumulative discount factor again? The same as annuity. Because the examiner might not use annuity for you. Cumulative discount factor. So once you do that, the present value will now be what? The present value will be what? 25,000 naira multiplied by what? Multiplied by what? Cumulative discount factor. I'm not writing it in full now. Somebody that will watch the video later should know that CD is cumulative discount factor. Cumulative discount factor. At what? At what rate? At 20%. For how many years?
10 years.
For 10 years. So when you do that, kindly compute that. Let's see. What will be the result?
The discount factor of 3.072. And the PV will be 76,000. Okay, the PV is 76,807.
Okay, can you check that again, sir?
Then you divide it, minus it from that. That is the negative.
Okay, somebody else should confirm that. Confirm, please.
The discount factor is 4.192.
Yes, I think that should be correct. 4.192. Yes, that is the discount factor.
Yeah, 4.192.
Yes.
So the present value will now be 1 million. Am I correct?
104,000.
And 48,000.
The result will be what here?
104,800.
104,800. 104.
Correct.
104,800. So that is it. So if you are now asked to interpret this, because beyond knowing the computation, you should be able to interpret. What is the meaning of this now? What is the meaning of this? Let me try and interpret this. Let's see next slide to interpret. But can somebody try? Can you interpret? Can anybody try?
What is
What is in party here? This is nice.
Hello, sir.
Yes, sir.
Not even in the interpretation I'm talking of. I'm still struggling to know how you did this because I thought we're supposed to have initial cost. You said the faith intends to acquire Idowu Limited. The acquisition will lead to an increase. What was the initial cost of acquisition before making that increase of 25% per annum?
The question didn't give us. The question is silent about it, and we are
Why must the question be silent now?
Please, serious. The question is silent about it, and we are being led by the question. Yes, we are not trying to bring in our own variables into the question. Yes, the question is our shining light, our guiding factor. So, and that is why we are working based on what the question has presented. And as a matter of fact, when you go to the hall, don't try to tell the examiner that this question is wrong. All right, but let's come back to class, and this is it, sir. The question says that Faith intends to acquire Idowu Limited, that the acquisition will lead to what? An increase of 25,000 naira per annum. So for year 1 to 10, there will always be an increase of 25,000 naira when Faith acquires Idowu. Now, the question is now telling us that let's assume 20% cost of capital. That what will be the maximum price to pay to acquire what? Idowu. So you ask the question that how much did
The initial
pay?
cost now before, yeah.
That is what the question is now asking you to determine. What is the maximum price to pay to acquire Idousa?
Okay.
The question is now asking you, what is it? If there will always be an increase of 25,000 naira every year. Now, Idowu is ready to let go her business to Faith. Idowu recognize the fact that she is earning 25,000 naira every year.
Month. Okay,
Every
yeah.
year. So if I'm to give out my business that I'm earning 25,000 naira, how much do you think I should sell that business?
Okay.
Considering the
Okay.
fact-
That comes to that 104,800 accumulated money that Faith will get from acquiring that of Ido.
Yes,
The 104,800, is it not now the accumulated that 25,000 per annum for 10 years? Is
yes,
that the answer? Is it not the accumulated figure or amount?
yes, that is it. So now, if Idowu is giving Faith a higher price, a higher value, Faith will evaluate Idowu. How much are you even making every year? I can't give you more than this.
Okay.
I can't give you more than this because by all estimation, you make a profit of 104,800 in the next 10 years.
Yeah.
And
Yes.
let's say your business life cycle will even decline at that point. Even though we assume business will always continue till perpetuity. Yes, but let's just give it a grace of 10 years and see what will your performance be. And that is why I was saying let's interpret beyond solving.
Okay.
And what will be the interpretation? What will be the interpretation of this now? That I will say from the above, because when you just know how to solve and the examiner is not trying to tell you advice as a financial manager in which you will see that you're a financial manager, from the above calculation, prospective buyer would be willing to pay maximum of what? Of 104,800 for the business. 104,800 for the business. The point is, any change in the estimates, of income or the appropriate discount rate now, or the appropriate discount rate, would affect the valuation. Once there is a change in 25,000 or the discount rate, this will affect the valuation. And more so, let's say it should be noted. It should be noted likewise that income stream may be adjusted. if prospective, if the prospective purchaser believes that the use of the business believes that the use of the business, let's say business assets, in a different combination and let's say and by different users would produce a higher income stream. So this can be an interpretation to the question solved.
Hello, Mr. Tokwe. Good evening, sir.
Good evening, sir.
Sir, let's say in reality, it's very difficult for us in reality, to determine the maybe the expected annual profit will be constant throughout for a good 10 years.
Yes,
So
very well.
it's not realistic.
Yes.
So what about in a process whereby we use discount factor? When you use discount factor, there's tendency that this 104 may be higher than this 104 or lesser than this 104. Probably when the return is not constant. So how are we going to advise them? Because at the end of the day, for example, I don't mean we use discount factor for this question. There's tendency that we are not going to get this 104. There's tendency that it's going to be higher or lesser than this. So how are we going to get the exactly price?
In this question, we've used discount factor. The discount factor is what that we've used. We didn't just show it in a tabular form because it's a constant cash flow, and we use annuity to determine that. Instead of doing it, since we have an equal amount of 25,000 naira, instead of showing a table, we use a discount factor of what? 20%. Of 20% for year 1 through 10. Through 10. So the point is this: we're trying to see how much faith will pay now, considering that there will be a constant inflow of 25,000 naira over 10 years. Now, where there is no constant inflow as a result of inflation or other economic factor that may affect the business, then there will be an adjustment. And in relation to inflation, the question will show us that. And where there is no constant inflow, we will not use annuity as we've used here. It means that if the question is telling you that in year 1, this will be the profit, in year 2, this will be the profit. It means what we've done here will not hold water. It means we'll have to present it in a table and see what will be the discount factor for each of the years. Then we solve and get our present value. For those that have followed over time, where we're treating redeemable, irredeemable preference shares, you see how we present and determine our present value. So, but in this case now, the inflow is regarded as being constant. And I think we're going to look at another example again, whereby in another scenario, whereby the inflow or the profit will not be constant, but not in regarding this present value now, but regarding growth rate. But based on the question you asked, where the inflow is not constant, we determine the discount factor yearly and not use annuity. And where the question wants to test your understanding on inflation, you apply the inflationary trend as the question prescribed to you. Yes. And if you followed other classes, you would have treated inflation. Yes. Because I think you're just joining us. So we've talked about inflation in some aspect, but I think if you've been following APES, yes, they've treated that also.
Yeah, we
And
have done that on investment appraisal.
yes, you would have seen that likewise in that
Yeah,
class. Yes.
yeah.
So let's look at another example regarding dividends, dividend yield. Let's look at another example regarding earnings now. Regarding earnings, let's take this example. Let's take this example. Let's see. Example is this. Let's say Patrick Limited. Patrick Limited has a maintainable earnings. Let me say which kind of English is this now? Has a maintainable earnings. Has a maintainable earnings of 240,000. 240,000 naira per annum. Those of you tired, don't worry. Soon close now. And some people's prayers that don't come to class. With a cost of capital. The cost of capital of 20%. Question is, what is the market value? What is the market value of Patrick Limited? Of Patrick Limited. Patrick Limited has a maintainable earnings of 240,000 per annum with cost of capital of 20%. What is the market value of Patrick Limited? So what will be the market value of Patrick Limited? This is a very direct one now. The market value of Patrick Limited will be what? Yes, very fast. Because this one is just a child's play. Example, another one. As you look at it, as I await the answer, help me. Let's come up with another example. Yes, what will be the response to this? What will be the market value now? This example is related to earnings, earning yield. And earning yield, the formula is what? For earning yield, the formula is what?
Any per share divided by current market value per share multiplied by 100.
Okay. Earnings per share divided by the current market value. Yes.
Per share.
Divided by the current market value. So in this question now, the earnings is what?
Any is 240,000.
240,000.
Yeah.
So in terms of market value now, what would be the factor to consider?
20%.
I'm hearing a voice on the ground. What would be the the rate to consider?
The cost of capital,
20%.
20%.
20%.
The
So
answer is 1.2.
1.2. I don't want to be treating this kind of. It's 1.2. So what I'm interested in is this. Noble has the following. Sorry, I'm not calling it with respect. It's just an example. Noble has the following results. Somebody is bearing Noble in this class. Noble has the following results. We have, let's say, 2003. We have 2004. We have 2005. We have 2006. And also the profit after tax. Profit after tax for each of the years. For 2003, we have what? We're going to have 6 million. 6 million. For 2004, we're going to have what? 6.2 million. For 2005, we're going to have 6.3 million. And for 2006, we're going to have what? Let's say 6.3 million likewise. 6.3 million. The company's cost of capital. The company's cost of capital. Company cost of capital is 12%. It's 12%. Required. Required. Calculate the value. Calculate the value of the company's, or calculate the value of the company based on the present, based on the present value of expected earnings. Of expected earnings. Looking at this question, what comes to your mind?
Present value.
Welcome back, man.
Thank you, sir. Good evening, sir.
I know you've not been in this class. You're present by in abstract. So looking at this question, Ma, you said what comes to mind?
Present value.
Present value. Okay. Present value. So how do we look at that?
The earning is not constant, so we are not using annuity this time around. We are using discount factor to discount it.
Okay. Okay. All right. What comes to mind is Gordon's growth model. Gordon's growth model. We showed an example, a formula, where when we have growth rate, right? Yes, we showed this. That is, we can incorporate earnings growth into this method as follows. What method is that? What method is that? That is the earning basis, the earning yield. If there's growth in your earnings, you can adopt the Gordon's growth model. In Gordon's growth model, what do we say about that? Gordon's growth model. Who can recall? When you are giving the value of dividend year by year, you are giving the value of earnings year by year. How do we treat that? Yes, how do we treat that? In Gordon's growth model. Any idea? In this
First, to
question,
determine the growth rate.
now you have how many years here?
4 years.
4 years. What will now happen when you are using the Gordon's approach?
Okay. The number of years is 4. Then the current dividend is 6.3. Then the base is 6 million minus minus 1, sorry. Then we need to present the formulas to calculate the growth.
Okay. All right. So we need to use the formula to determine the growth rate, right? And what is that formula? Let me write. Don't have time now.
R times B.
So since earnings pattern is not constant, we will determine growth rates. We'll determine the growth rate and once we determine the growth rate, so thereafter value will be computed. That is the expected earnings will be computed. The value of the expected earning will be computed. So now we computed using, that is EO, the bracket of what? 1 minus what? G, and divide that by what? We divide that by what? We divide that by, what is that formula we put here? Earning yield.
R minus
E. Divide that by EY. EY minus what? Minus G. But the growth rate, how do you determine the growth rate? You know, we can use the square root approach, right? The growth rate will be equal to what? Equal to the square root. This
N minus 1.
Yeah, n minus 1. Or this laptop I'm using today, I cannot get my symbols easily. So please, you understand that n minus 1, the square root of what?
Latest dividend. All of our base dividend.
Yes,
Divided by
latest.
base dividend.
Yes. So from the question, the latest earning is what? Profit is what? The latest is what?
Latest. 6.3 million. 6.3 million.
And yes. And the The earliest is what? 6.
6 million.
6 million.
6 million. So looking at the number of years is 4, right? So n minus 1. 4 minus 1 is what?
3.
3. Then into the square root of what? 6.3 divided by 6. Once you get that minus 1, you do what? The result will be what? It will be something like this. It will be something like this. That is 3. The square root of 6. Square root of 6.3 divided by what? By 6. When you determine all these, minus 1. So the result will be what?
Hello, sir. Please refresh this formula. I'm looking for it in my notes. I can't find it. So please just refresh the formula.
1.6.
Now you can see the formula in your book.
Divided by 6.
When we started cost of capital, sir, if you check your book, you see it. You
5.0.
follow the thing.
Okay. Is it,
5.05.
okay, let me look.
So the result will be what? As per the growth
5.
rate.
5 point. Okay. Square
1.6.
root of that. Six point zero five.
Somebody have gotten this answer and the person is keeping quiet.
I got 1.6.
I know you said something like that, so I think I heard you. So the growth rate should be 1.64%. So moving back to this formula here, your current earnings or profit is what? Current profit is what? 6.3, right?
Yes.
Into the bracket of,
1 minus.
it's not minus, please, it's plus.
Yes. 1
plus
plus
1, not minus 1.
1 plus what?
1.6.
1.64. Convert that to decimal. You should have what?
0.01.
0.01 what?
0164.
164. When you divide this, the earning yield will be what? That is the cost of capital.
20%.
Is it 20% now?
12.
So 0.12 minus what? The growth rate.
0.0.
That is 0.0164.
164.
The result will be what? When you do your computation, your result will be what? Madam Victoria, are you there?
Yes, I'm there. I've missed the class. I will have to go back to the recorded section.
All right. Madam Chikodili. I know how to call that name very well. Chikodili.
$1.898.
Final answer?
Final answer.
I don't know. Final answer?
About 61.808.
1.808. No.
36.3.
You know, sometimes to punch this calculator can be difficult sometimes.
Square root of answer minus 1.
But once you follow it, you get it.
4.
Yes, I'm with you.
Sir, please, I have been trying to find out how you get this 1.64 because from my own calculation, I have 1.446.
Okay, sir. So the third root,
Oh, fourth root. Okay.
third,
Third root. Okay.
that is 3,
4 minus 1.
then the root,
All right, I understand now.
6.3 divided by 6. Sorry, I'm not using my other laptop where I can easily bring in
Divided by
formulas.
6. .05. Shift 1.3. No. 36.3 divided by 6 equals to shift this.
Yes, if you look at the study pack, all these things here, this write-up,
6.05.
this is my slide for SFM. As I was going through my slide this morning, I was going through the study pack. I discovered that everything in SFM is what is in that slide. I've explained all this in the video I forwarded this morning. Yes, in that SFM class, I don't like listening to my class again, but I have to listen to it to hear my voice, to hear what I was saying. So I discovered I explained most of these things clearly in that video. If you've listened to it, if you've not listened to it, go and listen to it. Because if you go to the study pack and you follow their solution, you will not get it directly. Some issues are hidden. But in my explanation, I've actually break down some of these solutions. Though you see the solutions, let me show you this question. This question, the solution is right in the study pack, FM. But if you are asked, how do you determine this is the solution? How do you determine certain things here? You can be there for 2 hours trying to unravel how most of these things are derived. In that video, I've explained step by step. I have to listen to the video again and watch it again myself to see if there's anything I've not explained here. Yes, and everything I explained. For example, if you are trying to get this value, 25, this 25 million here, is not given to you directly in the question. You need to do some workings to derive it. So please watch the video and you'll be much more better. So also,
Sir, please help us to share the video for all that just joined today.
I will share it again, sir. So if you go to the study pack, I'm making reference to the study pack because the study pack is what you can finish this night. It's not anything serious as far as this topic is concerned. If you go to the study pack and based on the syllabus wants you to understand discounted cash flow basis, talking about NPV, talking about redeemable, all those things we've done in cost of capital, is still coming again. Yes, it's still coming again under this topic. So once you go through it, you're going to see the effect. You're going to see that it's just been repetition of those discussions under cost of capital. So take your time, study it, read through the study pack. Yes, and you'll be glad you did. So I have some questions here. Me, I'm going to solve on my own if I have my time and do a recordings, or if I have my time, can solve it in class likewise. But to end the discussion for tonight, this is the subject matter. Efficient market hypothesis. What does this entail? Efficient market hypothesis. Efficient market hypothesis. When we talk about efficient market hypothesis, this hypothesis states that security prices are fully and fairly reflect all relevant information. So what this concept is talking about is that the information you have, the information your customers have, will determine how well your business performs. As information gets to customers and they make use of that privileged information, does that information enhance the performance of your business? Or is it when the information is officially made known that your business is being enhanced? These are questions that this concept is trying to address. Now, if you read through what you have on this slide, this means that it is not possible to be consistently outperform the market by using any information that the market already knows, except through luck. So the idea is that new information is quickly and efficiently incorporated into asset prices at any point in time, so that old information cannot be used to foretell future price movement. So the 3 points, the 3 levels of efficiency are distinguished depending on the type of information available to the majority of investors. So we have the weak form of efficiency. We have also the market efficiency. And also we have the semi-strong form of efficiency. And also we have the strong efficiency. So when we talk about the weak efficiency, what are we referring to? The weak efficiency or the weak form of efficiency. In a weak form of efficient market, share prices reflect information about all past price movements. All past price movements in a weak form of efficiency. So past movements do not help in identifying the positive NPV, or past movements do not help in identifying the NPV trading strategies. It means that once you have past data, you cannot easily use it to predict the future. Once you have a past data, you cannot use it to predict the future. And that makes the market a weak one. All things being equal, you should be able to use past data to predict the market. So the point is this: in such scenario, there are no patterns or trends. There are no evidence. So prices rise or fall depending on whether the next piece of news is good or bad. That is in a weak form of efficiency. So the tests will always show that only 0.1% of a share price change on one day and can be predicted from knowledge of the change in the previous day. So there is no consistent way in which the market moves. So the stock market is a weak form of efficiency or efficiency. So future price movement cannot be predicted. Once there is a question and you're asked, explain weak form of efficiency, efficient market hypothesis. The clear feature is that future price movement cannot be predicted from past price movement. And also, technical analysis cannot help to make consistent gain on the market. So there are some people that talked about this weak form of efficiency. We have the concept of random walks that in 1953, Kandel presented a paper that examined share price movement over time. So he concluded that the prices of shares followed a random walk. That is, there are no patterns or trends. So any apparent pattern or trend purely occurs by chance. So price change because of new information. So no new information is by definition independent of the last piece of new information. So talking about efficient market hypothesis, all what this is all about information, availability of information. And when there is availability of information and the information is not in a consistent pattern, it is a weak form of what? Weak form of efficiency. Is a weak form of efficiency. We can have what we call the semi-strong form of efficiency. Semi-strong form of efficiency. In a semi-strong form efficient market, the share price incorporates all past information and all publicly available information. So the market information in a semi-strong form of efficiency is that all past data and current data are relevant to make a decision. So that is a semi-strong form efficient market is also weak form of efficient market because it has an element of past data in it, and public information include past information. So the point is this: share prices react very quickly to any new information being released. That is one key feature of semi-strong form of efficient or semi-strong form of efficiency. So the market reacts very quickly to any new information being released. So rise in response to breaking good news and fall in response to breaking bad news. So when there is a good news, there is a rise in the market share, in the market return. When there is a bad news, there is a sharp decline likewise in the market return. So the stock market is almost semi-strong form of efficient market because fundamental analysis examining public available information will not provide just opportunities to consistently beat the market, because the market trend can always fluctuate most times. When you listen to analysis of stock exchange every time, you discover that some people want to put in their money in a particular stock that is trading high, but at the end of the trading day, you can see a decline in the share price of such business. So solely relying on past data, past trend might not help. So only those trading in the first few minutes after the news breaks can beat the market. So when there is a good news, once you quickly harness that opportunity and make use of that privilege, then you can actually break forth. But after some time, the information becomes sunk, and not relevant as much. So since published information include past share prices, a semi-strong form efficient market is also weakly efficient. So semi-strong, all public information, including past share price movements, are made available. So the point is, as there is a small good news, a little good news, breaking good news in the market, there will always be a rise in the share value of that particular company in which there is a breaking news. And when there is a bad news, there will also be a sharp decline. So we can have strong form of efficiency. In a strongly efficient market, the share price incorporates all information, whether public or private. That is a strong form of efficient market, including information that is yet to be published. Yes, even insider information, insider trading, privileged information that is not yet made known form part of the strong form of efficiency. So insiders, directors, for example, have access to unpublished information. So if the market was a strong form or is in a strong form, the share price wouldn't move when, for example, news broke about a takeover, and as it will have moved when the initial decision was made. So in practice, most of these issues do happen, whereby because you are working in an organization and you foresee that you have a privileged information that this organization will soon be sold out, will soon come to a state of liquidation, you quickly use that privileged information to buy or sell all your stocks in that organization, and that is a component of a strong form of efficiency. And in this strong form of efficiency, there would be no need to ban insider dealings. Yes, there will be no need to ban insider dealings. Yes, the fact that you are an insider, yes, you have the privilege. You can as well work with the information. So as insiders couldn't make money by trading before news became public, it is banned because once they do, they make use of such benefits or advantage. So the point is this: the stock market is not strong form of efficient market hypothesis, because insiders dealers have been fined and imprisoned for making money trading in shares before the news affecting them went public. Yes. So the stock exchange encourages quick release of new information to prevent what? Insiders trading. That is a strong form of market hypothesis. So privileged information should not be permitted. Information should be released promptly to the public so that nobody will take advantage of little information at their disposal. The semi-strong form of market hypothesis have you can use past data and a little bit of new information release to determine what will happen. So this insider dealing, it is well known that shares can be traded on the basis of information, not in the public domain, and thereby people will make abnormal profit from that. So stock markets are not strong form of efficient market hypothesis. So for example, the engineer who discovers gold may buy shares before the discovery is made public. And also the merchant banker who bears or who hears a colleague is assisting in a surprise takeover bid has been known to purchase shares in the target firm even before any other person gets to know. And also a breakdown in the fair game perception will damage investors' confidence and reduce investment. So to avoid a loss of confidence, most stock markets have codes of conduct. Yes. And countries have introduced legislation, yes, to curb insiders dealing. So in order to prevent people taking advantage of privileged information, I think there is a topic in FR or corporate reporting that talks about there's a standard that relates to this insider trading and the rest of it, whereby we are not permitted to employ both a whole family in an organization, because the family can take advantage of such information and the family can take advantage of such information and do well, do good to themselves at the expense of the business. So you can tend to read more about this in the study pack. So the point is, in an efficient market, share are priced to give investors the exact return to reward them for the level of what of risk in their shares. So as a result, the purchase of share is a zero MPV transaction because the price paid for the share is an accurate reflection of its worth. No any privilege information. No any privilege information in an efficient market. So that is what this concept is all about. I remember while I was writing, you call this question coming up in the Pathfinder. If you check the SFM Pathfinder, just type efficient market hypothesis. You'll see where it's being tested and asked. So you can lay your hands on SFM Pathfinder, the soft copy. Just do a search and see how the question is being asked. So it's not a big deal. They just ask to explain the efficient market hypothesis. And what you have to do is just to explain the three forms of efficient market hypothesis. That is what the examiner wants you to do at that point. So I have just a simple question. Is what you can solve within 2 minutes. And also we have some other questions here. I'll do just got to be free during the week. I'll do a personal discussion on that, on some of these questions, calculate the value of equity. This is in relation to discounted cash flow. You can see the issue of WACC coming in, inflation coming in. I'll forward the slide in case you can attempt it, fine. In case you can attempt. Quite a number of questions. Like this is another question. You're required to value 200,000 shares in Accreton company on a PE ratio basis. Another question in that order. This is a question on asset-based valuation. Yes, they are not something complex. Very simple. So I would like to call it a day at this point. So please do well. The summary is do well to go through the Pathfinder through the study pack and study this to have a broader understanding. So for this topic, for this aspect of the syllabus, I think I don't have anything to do with it again. Everything I'm here to discuss, these questions, I'll treat them and we'll move to the last part of that syllabus. Yes. And the last part of the syllabus is talking about what? Let me see if I can access the syllabus. Because in October, by middle of October, is expected to be meditating with your book, Summary of Financial Management. Okay, fine. I think I've seen the syllabus now. Let me share my screen.